It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money show. This is the most fun you're going to have talking about money. I promise you. We are the program that takes the mystery out of your financial life. We do it with a sense of humor. And I laugh so much. I should just give you the soundtrack of actually what's happening when we go on the air here. It's fantastic. Okay, so if you've got a financial question, the way you get on the program is you just send us an email. Ask Jill at jillonmoney.com. Oh, I forgot to say we're broadcasting live from the Capital One Bank Studios. We are broadcasting live from the Capital One Bank Studios. See, I did it twice to make up for the fact that I forgot about doing it once. Okay, now, next, if you have a question, email us, ask Jill at jillonmoney.com. That's what Linda did. She is calling us from New Jersey, the Garden State. Hello, Linda. How'd you do in the heat?
Very well. I'm doing great.
Good.
How are you doing?
I'm great. What can we do for you?
Well, I have a question for you, Jill, and I want to say thank you so much for responding to the email that I sent in to you. I'm almost 59 years old, and I plan to retire at age 65.
Okay.
My current plan is to defer Social Security until age 70 and instead use savings for living expenses from age 65 to age 70.
Great.
Still, my question is, how should I invest this money that I need to live on for those 5 years? How do I invest it now, given that I won't use it for another 6 or so years?
That is an excellent question. Okay, so let's go through a few things. Number one, when you are 70 and you've got that Social Security benefit, what other income would you have available to you?
I would have savings in an IRA or 401k, as well as I'll have a small pension.
Okay, so how much money is in the savings? Let's do the savings first. So the non-retirement account, how much is in there?
A little over $1 million.
Okay, great. And is it currently invested, or is it somewhere else? Like how? Where?
Yeah,
what,
it's invested. It's invested in stocks.
All stocks?
International and total stock fund.
Okay, so all stocks right now, right?
Yeah, and then the bulk of my 401k is in bonds within the 401k.
Okay, how much in the 401k and IRA?
About $1.2 million.
Okay, great. And are you single or are you partnered?
Single.
Okay, kids?
No kids.
No kids. Oh, we got just take care of you. This is good. How much money are we going to need to draw down from the $1 million of non-retirement savings on an annual basis?
Non-retirement. You know what, Jill? I didn't figure that out. I figure I probably want about $70,000 a year to live on.
Okay, that's fine. Mm-hmm. And there's no other income right now between, let me say right now, but there will be no income between 65 and 70, right?
Yeah, right now I would like to not work at all.
Okay, that's fine. How much do you earn right now?
Do I have to answer that?
Well, I'm just why? No one knows who you are. Don't worry about it. Just because I want to get a sense of is really $70,000 the right number?
Yeah, I earn about $160,000 a year right now.
Okay, no shame in that. It's good. And you're putting the full amount into your 401k. In other words, right now, because you're over 50, $25,000 a year.
Right.
Great. How much money do you put away in savings on an annual basis? Would you not the 401k, but that $1 million kitty? Are you adding to that every year?
I am. Right now, I'm trying to target between get between $30,000 and $50,000 a year.
Wow, that's awesome.
Yeah, it depends though. I'd say probably closer to 30.
Okay,
30 per year. Yeah.
Perfect. That's fantastic. Okay. Then I see, I'm just sort of backing into do I really trust your $70,000? I do, because you're saving a lot of money. Do you have a house that's paid for?
Excuse me?
Do you have a house that is paid for?
I sold a home, so I don't currently have a home. I do plan to purchase another home, and I would do that with cash. I have cash on hand to buy another home.
Okay. How much would you spend on a new house if you were going to do that?
I'm thinking between $200,000 and $250,000 because I want just a condo. I downsized from a larger home.
Okay. Would you stick around this area? I'm saying this area because I'm in the New York metropolitan area. Would you stick around New Jersey, or would you move somewhere else in the country?
I would stick around this area.
Okay. Very good. I think the first thing to remember, I know you've got some time before you get to 65. So you've got 6 good years. And, obviously that $1 million that is saved is going to keep growing. I would probably dial back some of the risk in that account. So,
Okay.
and it doesn't have to happen all at once. It may be that you say, okay, it's all in stocks, the others in bonds, but you're going to need to pull money out of that account in
Right.
6 years. So I might start to say, well, maybe if you do you own individual stocks or mutual funds?
Mutual funds.
Does every mutual fund that you currently own, is it have a capital gain embedded in it, or are there any losses in the account?
Right now there's capital gains.
Only. Yeah. Okay. So I think that what you're going to have to do is maybe take a look at the portfolio, and maybe as you add that 30 grand a year for the next 6 years, I would put that 30 grand in very low volatility, very low risk assets, even if it's not going to make you a ton of money. In fact, I might even say to you that, by the time you get to age 65, I want 30% of whatever that portfolio is, maybe even 40%, to be safe, because you're going to have to pull money out. And I don't want you to be worried about pulling money out if the market takes a dump the day before you need to start retirement.
And when you say total, is that across both my after tax as well as the 401k?
I'm really only talking about the actual non-retirement account. The
Right,
bonds.
Okay, right, exactly.
Because the bonds, it's fine to have the bonds that are sitting in the 401k. I think that the problem is that if you never needed to touch the $1 million in the non-retirement account, you would have a perfectly balanced portfolio. The problem is we have to take money out of that portfolio.
Right.
So what I would be looking at is, very clearly saying, okay, maybe this is a time for me to check out, what is it in my account? Is everything really working? Do I have any duplication? Is there any asset I actually would want to sell and pay the capital gains on? Maybe yes, maybe no. But the new money that goes in has got to be safe. Because remember, what I would like it is that if you retire at age 65, I would really love it if you had 2 years of cash available to you, meaning that you had basically 150 grand of that $1 million in cash, so that if we were in some prolonged horrible market, you wouldn't care.
Right.
And that's how I would proceed. I think that it sounds like you're doing a great job, but when you need to tap an account, even if you would have access to the IRA and the 401k, I think it makes more sense for you to have some money in advance. Now, I also will tell you that by the time you get to 65 or 66, if tax law were still the same exact law as it is today, and you go from having 160 grand in income to zero, maybe you would pull some money out of the IRA or 401k and pay a little bit of tax on it. But the combination of having a little more cash in the non-retirement account and also monitoring, you'll probably call us back in 6 years and we'll see where are the tax rates. Because if tax rates are low enough, maybe you do a little bit from each. Maybe you take some money from the non-retirement assets and some money from the retirement assets. We got to see. But you're in great shape, Linda. Gold star to start the program. Thank you so much for calling. If you would like to come on the air with us, please don't think twice. Go to JillOnMoney.com, click on the Contact Us button. While you're there, sign up for our free weekly newsletter. It comes out every Friday. Check it out. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back. It's Jill on Money, and we are delighted that you're with us here. Just want to remind you that we have all these social profiles that Mark is very assiduously taking care of on my behalf, because I get hurt feelings when people say mean things, and also don't love the anti-Semitic things, guys. Just got to say, not happy about that. You can follow us on Twitter, Instagram, Facebook, YouTube, at Jill on Money. Mostly, I'd love you to go to our website. It's called JillOnMoney.com. And you know how much I love you? I love you so much that as soon as that Equifax settlement came out, I just popped up a quick reminder about what that settlement was all about, with links to everything you need to know. Most important thing is that ftc.gov/Equifax. ftc.gov/Equifax. That's where you're going to find lots of information. All right, next up, we have got Bob from the Bay Area. Hey, Bob, welcome to the program. What can I do for you?
Yeah, good morning, Jill.
How are you?
I'm doing great, thank you.
All right, what's up?
I retired 4 years ago at age 58 from a company I worked for 35 years, and I just turned 62 this week.
Congratulations.
Yeah, thank you. And I had a 401k, and so I converted the 401k and the pension lump sum from my company to an IRA.
Mm-hmm.
And
how much money's in there?
I also have a small Roth IRA.
Okay, how much is in the regular and how much is in the Roth?
Yeah, so in the regular, I have it with a wealth management company I work with, and I have the total is $1,925,000.
Okay, can I call it 2 just to be safe? Let's call it 2. I love round numbers. $2 million. What do you got in the Roth?
Yeah, I like $2 million too. And then the Roth is just 75.
Okay. Tell me about yourself. Besides being retired, are you partnered or are you single?
Yeah, no, I'm single.
Okay. Own or do you rent?
No, actually, I owned. When I came out here in California from Texas, first house, I knew I wanted to try to rent something someday, so I paid it off. I've been pretty good about paying things off, paying extra on payments. So
great.
2 homes that I have, they're both paid off. Of course, I'm paying property taxes.
Oh, yeah. How much are each of those homes worth? And are you going to keep both now that you're retired?
Yeah, I think I want to keep them. At some point, I'll sell. But they both average around $700,000 currently.
Great. Okay, this is good. So this is a good story so far. And right now, what are you living on in terms of, because you just turned 62, what is your income?
Yeah, no, you're right. I have no Social Security yet. I've been pulling from this wealth management account $5,500 a month.
Mm-hmm. Is that enough for you?
Well, one thing I didn't tell you was one of the homes I rent out, and I rent that out for $3,200 monthly.
Okay, and that, I mean, I presume that the property. So, what does it net you? That's $3,200, but is that you got to pay property taxes and upkeep? Does it tend? I don't know how much is what the taxes are, but does it end up being like $2,500 a month after you've paid for everything?
Well, let's see. It's about $4,500, $5,000 on the property tax.
Right.
Year.
Yeah.
And then there's a homeowners association that I pay that myself, and that's $130.
All right, so I think it's fair to say that net on that rent, $2,500 a month.
Yeah, so that's probably pretty good.
And the $5,500 a month that you're pulling from the IRA, that's with the wealth management firm, that's after tax. So you obviously have to pay tax on what you pull out, but so essentially what you're telling me is that the $2,500 a month plus the $5,500 a month, that's what you need to live on. Is that right?
That's correct.
Okay,
yeah.
So you got the $8,000 a month. What is your Social Security estimate for your full retirement age?
Oh, I didn't know you were going to ask me that.
Oh, why do you have the 62 one?
I didn't want to really think about it because I didn't want to, be tempted to try to take it out.
Okay, good. Forget it. We'll wait. How much did you make when you were working for the last? What's about what you made as when you left your employment?
Yeah, it was about $140,000.
Okay.
But real nice benefits.
Okay, fantastic. What are you doing for health care, by the way? Because you're not Medicare age yet.
Right. So the company, had a plan, and so I'm paying about it's about $1,250 a month.
Okay.
And that's medical, dental.
Yep. Great. All right. So now let's get to your question because I've made you work hard here. What's the question here?
The firm I'm with, it's a 1% management fee. I went back and calculated all that.
Yep.
and then the Roth is it's about 75,000 on the Roth, and there's no charge there. I'm about 80% stock and 20% income.
Yeah.
And then for fun, I have a personal brokerage account, and that's about 36,000. So I have fun trading.
Okay.
That keeps me pretty active. I enjoy that.
Great.
As far as emergency fund, I'm pretty low on that, about 15,000, and just a basic savings.
Okay.
So my question was, I'm planning on just delaying the Social Security, and just wanted to ask you about that. And then, it's as far as the IRA account, I should probably leave it like it is. Probably don't pull from IRA and pull money into a Roth. I mean, I know that's an alternative, but
well, okay.
Yeah.
First of all, your income is low right now. So, I mean, then, certainly taking some money out of the retirement account that's being managed seems reasonable. I would say this, though. I don't know what your managers have said. And by the way, 1% is that, I don't know if that's the best they can do, but it's probably pretty decent, $2 million account. I would be wondering whether you should reduce some of your equity exposure, because you are living on this money now, and we'd rather it not be quite as variable as it once was. So what I might say to you is that I think 80-20 is a little bit aggressive. I would be much more comfortable with 70-30, 60-40. That's kind of where I would go with it. And there's no downside to actually doing that, because I feel like you've got plenty of money. You don't really need the upside in the market. And, eventually, I mean, there's a couple of things that are going to happen for you. Number one is, if you delay until you're full, you can sort of have two decision points. You can live right now until your full retirement age. You should go to ssa.gov to see what your full retirement age Social Security benefit would be, and then you should look at what your benefit would be at age 70. But I think that certainly while the tax code is in your favor and tax rates are low-ish, they're pretty low, actually, I wouldn't mind. I think the $5,500 a month is just fine pulling that out of the account. I guess the question is, at age 65, you don't need the health care anymore. Then you get Medicare. You'll need some supplemental Medicare also. And then you will have the Social Security. So I presume in the next 5, 6, 7 years, you're not going to need to pull $5,500 a month out of that portfolio. I think you're going to probably end up pulling $3,000, maybe $3,500. I don't think it's going to be much more than that. And you've got plenty of money. So I think this is all a very good scenario that you've laid out to me. I think that the most important thing that you should be concerned with is preserving the $2 million nest egg that you've worked so hard to create. To me, that's your goal right now. And if you can do that simply by changing the risk level, just reducing that equity and going more to a 60-40, 65-35, 70-30, that to me would make a lot of sense. Otherwise, I think you're in great shape. You got plenty of dough. Good job. Go to ssa.gov. Let's look at those numbers. And if you have any questions, do not hesitate. Call us back, okay? Thanks for calling, Bob. And if you, like Bob, have a question, maybe it's about your retirement, maybe it's about real estate, who knows? Give us a holler. Just go to JillOnMoney.com, click on the Contact Us button, and we will get that email from you. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back. It's Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Hey, Mark, how are we doing with Twitter followers? Not that I care that much anymore. I mean, you can follow us. Mark, you do tweet a lot of good stuff out there. I pop in every now and again. I just don't go to the toxic part. Mark made me stop basically looking at my social media because people were so mean. And I have a very thin skin for a hard-ass lady, right? Are you surprised at how thin-skinned I am, Mark? Yeah. So funny, because I'm a big mushball. All right. Anyway, follow us on Twitter at Jill on Money. Here is a tax question from Rita. Oh, boy. This is a tough lesson to learn. Rita says, we learned a lesson last tax season. Fees to our financial advisor no longer deductible. Is this correct? Yep. And we pay a percentage each quarter. It amounts to $20,000. We're looking for some tax relief. Hey, maybe we should look for some fee relief. You're not getting tax relief. You can't do it anymore. But what you can do is you can go to your advisor and say, hey, we used to deduct the fees, and ask for a lower rate. Maybe you'll get some traction on that. Maybe. You never know. Jeffrey writes, I just turned over my pension to a self-directed IRA. I'm thinking about purchasing non-developed property acreage within the account. What are the pros and cons? How will it be taxed when I turn 70 and a half? Who would handle this transaction? Ay. There is a whole long process for putting real estate like that in a self-directed account. And it is a pain in the butt. But here's the thing. You have to go to a very specific kind of organization that does this. And there are usually higher fees for doing it. But, and I don't really know, honestly, it's not like my favorite thing to do because I feel like this is a high risk kind of endeavor. That said, you have the self-directed IRA. A lot of companies do it. I presume they're going to guide you. They'll tell you about all of this, all of the rules. The thing is that you're going to be responsible for finding the property, but the SEC has said that these are really rife with fraud, so that's a problem. Now, what's the benefit? Real estate in an IRA grows tax deferred, right? But if you don't follow the rules very specifically and you do it the wrong way, you disqualify the whole thing. So if you're thinking, by the way, that you can purchase a vacation home for anyone else listening, no, you can't. It has to be all arm's length transactions. So no self-dealing, nothing that you get. Anyway, I would talk to an advisor about this. I would never do this on my own. So please be careful, Jeffrey. Kind of scares me. John is 62. He wants to move $20,000 from a traditional retirement IRA, which is invested in an index 500, to a Roth. He wants to do it for the next 5 years. I've got the entire year to make the $20,000 sale purchase. My question, should I wait for, quote, a dip or a peak when I make the sell purchase? My gut says to make the switch when the market is down. Mark, how would you like to answer that? Just tell me when it's going to be, Mark says. Just let us know. You're rolling the dice, man. Just do it. Just do it. And, it's not going to be perfect. You're not doing the whole conversion thing. The timing issue is less important. Even if you miss 3 days, who cares? Just do it. Don't get yourself knocked, literally, people make themselves crazy. They want to time the market. It's not really what the whole point is. The point of the Roth conversion is really, it's a tax arbitrage. Don't worry about the market. Just do it. Okay. Nancy wants to know, 30 years of marriage, now she's getting divorced. Ay vey. $500,000 retirement account divided equally. I'm 55, my husband's 62. His job is minimum wage, and I make about $40,000. What is the best financial path for us? I think you each are probably going to need your own advisor. Your best financial path is to try to figure out, with lawyers or with a mediator, how you're going to kind of keep contributing. But, the rules are the rules. Most divorce laws are ruled by the states in which you get divorced. And you're going to have to both create a financial plan. And if you can't do that yourselves, you're going to try to hire someone who will help you. But it's just terrible. Divorce is also very bad for your financial plan. Not necessarily you should stay together for the money, but maybe you should stay together for the money. You both need a financial plan, sorry. Marilyn is 79, her husband's 74. They have $600,000 invested, $130,000 in safe money market CD, savings, checking. House is worth $250,000, debt-free. With our income, we're able to save approximately $1,000 a month, which we put into the money market. We have a will. We wonder, is there any advantage to a trust? Nah. I mean, yeah. Okay, wait. The advantage of the trust is you can leave your money exactly how you want to leave it to your kids. But you don't need to do this. I really don't. But I think that you need to have an updated will. The money that is, in the investment account and the money markets, it has to go through probate unless it's a retirement account. So too with a house. I don't know if you really need a trust. Seems like a little bit of overkill for you, but you do need updated estate documents, a will, power of attorney, healthcare proxy. Those are your big ones. Okay? So that's that. This is an inflation question. With the cost of everything increasing, will currency be obsolete even though we are working to that? No, it won't be. How about that, Mark? Will there be certain low denominations get sort of filtered out through the currency? Probably, but hasn't happened yet. I mean, we still have pennies and we lose money on every penny that we actually create from the U.S. Mint. So, anyway. Time, my friend? Under one. Can I do this quickly? Linda always received a refund on her taxes. Now she pays $1,400 in quarterly estimates. Oh, I see. This is a follow-up, and there's nothing really to say about this, people. When you have to pay taxes, you have to pay taxes. I can't make it go away. So there's, you can try to get yourself to a different place. But if you are being told you have to pay taxes, please pay your taxes. How's that? All right. You're listening to Jill on Money, where we always pay our taxes on time and happily rejoice when that check is finally in the mail. All right. You're listening to Jill on Money. Ask Jill at jillonmoney.com. That is our email address. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. If you've got a financial question, just give us a shout. Ask Jill at jillonmoney.com. Head to the website, jillonmoney.com. There you can check out all the stuff that we are posting, articles, also known as blogs, or videos, TV appearances, old shows. All that stuff. Okay, we got a note from somebody who's 37, a respiratory therapist, but feels burned out and said, what's the best way to go back to school without depleting the savings I already have and taking on too much debt? Good question. First of all, are you sure you want to go back to school? Is there a certificate program? Is there something you're going? I mean, you don't mention enough details here, so I can't tell you like in what field, what you're thinking about. But the reality is that grad school debt is piling up. And it's insane. So, there are certain programs where it's all subsidized. But just like undergraduate, got to take a look at the cost and what are the benefits. All these horrible stories we hear from people all the time. They have got tons and tons of debt and they got degrees that don't pay off. So do some research. Let us know what the field is that you're considering, and then maybe we can help you out. Nancy has been a faithful listener of Jill on Money for a while. I am a low-income single mom, age 44. I work part-time without any benefits and no 401k. This year, because I heard about the Savers Credit for Low-Income Families, I opened a Roth IRA from Vanguard. I did a little research before I opened it. I knew I should buy the low-fee index mutual fund, but all the index mutual funds were closed. So I bought a Target Retirement 2045. Can you tell me if that was the right thing to buy? If not, what's your suggestion? Mark, they're not closed. I think it may have been a institutional share type that you checked out. So let's do this. I'm going to go right now. I'm going to Vanguard.com. Hear me clicking? That's the power here. And then I'm going to personal investors. Yeah. Okay. So now let's see. Vanguard mutual funds. Oh, stand by. Let me just do this. There's a whole big thing here. Investing index funds. Here we go. Let's look. Ready to do it. Yeah, I'm ready to do it. Let's go. Stock funds. Browse Vanguard index mutual funds. Let's see what we're going to open for her. Okay. I'm going to click on this asset, and this is bonds, balance, target date, target risk, U.S. stock funds. Hey, look at this one, Mark. Vanguard 500 Index Fund. Looks good to me. That's kind of good, right? That's the one to do. Maybe I wonder if it's because there was a minimum. Maybe there was a minimum investment. Yeah, I mean, the Admiral funds have a minimum investment requirement of $3,000. Maybe that's why you couldn't get it. In which case, you can just wait, and then, like, after next year, when you have $3,000, then go into the Admiral fund. It's not a bad decision. You're fine. You opened it. Kudos to you. So, Nancy, this is good news. Once you have $3,000, then roll it into the index fund, and that's that. How about it? You know, I think, by the way, I should check this out. TD Ameritrade used to be one of the few families, I'm going to look this up, where you didn't have an IRA minimum. And I think that is something we should be talking about more. Let's see, opening a TD Ameritrade account. There is no minimum to open a new account at TD Ameritrade. How about that? So there's something to keep in mind. Maybe check out TD Ameritrade. So that's something to at least consider. Okay, this is a note from Thomas, whose subject line reads, "Where to keep RMD for next year's income." Here's the message. I have my $138,000 retirement IRA invested in the Vanguard Target Retirement Income Fund. The asset allocation in the fund is about 70% bonds and 30% stocks. Here's the core of the question. I need my required minimum distribution for annual living, and I'm wondering if I should put next year's distribution, which is about $4,800, in a more stable fund, like the money market. This would give me my annual RMD and hopefully time for the fund to rebound. What do you think of this idea and of the particular fund? I do want to stay with Vanguard. So I love Vanguard. I think that any money that you need within the next year or two even, I would always put in the money market. I wouldn't mess around with it. I think that that's your best bet. So absolutely go ahead and do that. No risk with the money you need in the next year, especially for your RMD. This is a message from Kay, who Kay disagrees with research. I always love when people say that. I disagree with research. Well, too bad. I'm completing my graduate coursework in special education. I teach economics and personal finance to high school special education students with learning disabilities. I have an undergraduate degree in economics. Financial literacy programs are relatively new. There's simply not enough information to say they're ineffective. I know plenty of mathematics competent folk who don't understand various aspects of personal finance, investing, trading. Just because you're competent in math doesn't mean you're financially literate. I do community outreach, and what I'm finding is people who are learning these things are improving their personal finances. This is great. Fantastic. So, I mean, look, keep teaching. Good luck. And I hope we get different, hopefully the research will end up playing out that way, for sure. That's what I got for you. When we come back, we're going to do a little bit of annuity follow-up. How about that? It's Jill on Money. If you've got a financial question, give us a holler. Ask Jill at JillOnMoney.com. We'll be right back. You're back. It's Jill on Money. We are broadcasting live from the Capital One Bank studios here in New York. Frank has a Social Security question. He says, when I read my Social Security statement, it says that it assumes I keep working. What if I retire at age 63 and I don't claim till 70? I'm not paying in after age 63, so does my benefit still increase, and by how much? Thank you, Frank. Well, look, the benefit is that if you delay waiting till age 70, based on your 40 quarters or 10 highest years, you'll have that benefit increase over time. And, about a little bit from 62 to your full retirement age, and then 8% from your full retirement age to 70. And the benefit will increase, and it'll pay off if you live longer. If you're not paying into Social Security at age 63, it doesn't matter. It's whatever your 40 quarters are going to be your 40 quarters. So it's still a good bit of math work in terms of like what's the best thing for you, because you still have to figure out how you're going to live between ages 63 and 70 and how you're going to pay for stuff. Quick follow-up to from Jean about some annuities that she had asked about. And basically, she wants to know that she's not making any money on her annuity investments. Is there a better way to go? And the answer is usually there is a better way to go. And if you can draw on them in 2 years with no penalties, or 2 or 3 years, and that would be a great time to roll things over. And if they are qualified annuities, meaning they came from a retirement account, you just open up an IRA account. If they're non-qualified, you've got to find out if there's any tax liability. And Jean, my book's already out. She asked about the book. The book is called The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. If you go to JillOnMoney.com, guess what? There's a link right at the top of the website, and it says the book. Isn't that fabs? Love it. All right. So there we go. That is the end of an hour, and we thank you so much. When we return, more of your questions and also a little bit of yakking with a guest. How about that? Stay tuned. If you have any questions during the break, just go to JillOnMoney.com. Again, you can buy the book. You can sign up for our free weekly newsletter, and you can check out all the great resources we have. So, JillOnMoney.com, that's the website. Hang in. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You are back. It's hour number 2. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. And, by the way, I was just talking to some guys who do an insurance podcast, and I said, so many mistakes are made around insurance. And some of those mistakes are just, kind of blowing off getting coverage. But other mistakes are just, people who are buying stuff they don't get. So be sure to cover your insurance needs. And if you don't know what those are, maybe you're going to have to go buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. All right. In this hour, we're talking to the folks of CommonBond. We're starting with Kelly Peeler, a friend of the program. We're going to cover everything families need to know about how to get their kids through college. So whether you are going for the first time, you're applying for college aid, whatever it is, they are going to help you out. It is Kelly Peeler. We're starting with Kelly first from CommonBond. So if you've never heard me interview Kelly before, shame on you, but let's do a little bit of your background. So Kelly, you went to college and then you were studying bubbles, right? Financial crises?
I studied the history of financial crises during the housing crisis, which was interesting to say the least.
In live time, right?
Yeah, in live time.
And then you stumbled upon the idea that potentially the next big crisis could be the student loan crisis, right?
Yeah, I worked at JP Morgan covering financial institutions and was asked to make $100 to $200 million cross-asset allocation investment portfolios with a few clients who were interested in trying to short the student loan market. And that's when I really started digging into the $1.5 trillion student loan market that affects 44 million Americans, and was like, oh, wow, this feels like a lot, very similar to the housing crisis, a lot of similar leading indicators. That's when I was like, wait a second, I really want to try to think about redesigning this entire process for the now 70 million people who are considered Gen Z, or the next wave of millennials, and make it more transparent and trusted.
And so you created a company called Next Gen Vest.
Yep.
And the core concept that was underlying that was that you were, was that you matched students with money mentors.
Yep.
So who are the money mentors?
Money mentors are trained college students, so they themselves have had loans. They've probably done work study, and they were looking for a way to both help other students get trained. So they're probably interested in going to financial services and make some money on the side. And so we train money mentors. We put them through a whole training program. And what they do is they talk and coach students anywhere from 17 years old to kind of freshman, sophomore in college through the whole process. So anything from finding scholarships, filling out the FAFSA, negotiating their college tuition, understanding their financial aid packages, picking the cheapest meal plan, and really kind of in a way that's relatable to an 18-year-old kid. Our whole platform is over text message, so you can get help at 11 p.m. on a Sunday from someone who's kind of like you and who's been there before.
Those kids, they communicate differently.
Yeah.
They love text.
They love text. They love memes. They like emojis. They like GIFs. They like putting filters on everything. And so money, and especially student loans, is this really, really stressful time period for an 18-year-old. I mean, they're basically buying a house, right? They're signing up to buy a house, $200,000 to go to college. And they're doing it with not a ton of guidance. They're doing it where their source of truth is potentially their parents, who the cost of college was totally different for parents. So they're not really totally knowledgeable of how this goes. Maybe their college counselor who is trying to help 500 other kids, or trying to Google and read crappy blogs.
Right.
And so what we found, kind of our key insight is that stressful money topics have to be discussed or made more transparent by someone who you trust. And that happens to be, for our user, which are, an 18, 19-year-old kid, someone who's already been there, someone who's gone through the process and who has been trained, who can also talk to you in a relatable way.
And using a money mentor was a free service, right?
Yeah.
Just explain this before we get into like what your next phase has been, because that was free. How can you provide such a service for free, or how were you able to?
The short answer is that our broader vision was to really think about how do we redesign the whole process of student loans. So whether that was making our own loans at some time, maybe that was introducing a subscription service, but we found a partner in CommonBond that we really aligned with our broader mission and vision, who acquired us, which was really exciting for our team so that we could continue to offer the service for free, and not be pressured to do anything that would be against the actual interest of our end user.
And is it moneymentor.com or?
Yep, it's money-mentor.com.
Money-mentor.com.
Yep.
Okay, and so how have people stumbled upon you? Do you go and talk to guidance counselors, or how do you get the word out besides us?
Yeah, we do. Yes, we go into high schools and do workshops for free. If you're a parent or a student at 1,000-person high school, we will come in and help your college counselor. We'll host FAFSA nights. We'll host how to negotiate your tuition nights, and then we'll sign people up for money mentors if they want additional help.
So a few weeks ago, I did a segment about college and student loans, and we found this woman who had graduated undergrad with pretty reasonable debt, maybe say $10,000. Okay.
Yep.
But it was she was very interested in art history. She really wanted to be like a museum curator.
Yeah.
She then went to grad school. It
Okay.
all went down.
Sorry, I should know that reaction.
Yeah, I know. It's like it all went downhill from there. Anyway, she ends up with a wonderful master's from a nice school and about, let's say, $60,000 in debt. When she got out of that program, she could get a job that actually paid $11 an hour.
Wow.
Okay, so
Which I'm also not surprised.
I
by
know,
that.
right? It's so hard.
Yeah.
So now she gets out of school. She takes her $11 job. She's living in New York, trying to, like, great arts community.
Right. Yeah.
It was bad.
Yeah.
So anyway, long story short is that flash forward, she ends up with paying $20-something thousand down on this debt and still has an outstanding loan balance now of $65,000 or $67,000. She went back and got a certificate in coding, moved back to North Carolina, got a great job,
There you go.
and tackling the debt.
Good for her.
Okay, so now we come out, we've done the segment. And I given my advice. And so I said, well, obviously we would like to have different conversations before she assumed that debt. It'd be great if she could have figured out that there are actually no jobs in that industry and that they pay really crappy and that all this stuff, right? And then we were talking about broader advice, and I talked about negotiating with schools.
Right.
I got a very interesting email from someone who said, stop perpetuating the myth. She says, I work in college admissions.
Yeah.
And she said, and we don't negotiate ever. And I said, that may be. And so I wrote her back very nicely. Maybe true at your school.
Yep.
I know countless instances of negotiating.
Yeah.
Can you back me up on that?
100%. We help students in the past year and a half negotiate over $300,000 in tuition costs.
Sometimes it is.
Which doesn't apply to every college, for sure.
Right, of course. But there are some times where you say, hey, I got this offer from this college, and they're giving me a $25,000 a year free money, right? A grant. And we'll talk about that.
Or a merit scholarship.
Or scholarship, right?
Yep.
Can you do something?
Yep.
And sometimes they say no. But as you said, sometimes they say
Just
yes.
like asking for, a raise in your salary. Sometimes your boss says no, but it's worth asking.
Okay, we will get back to our conversation about applying for financial aid with the folks from where? CommonBond. Yeah. If you've got a financial question, shoot us an email. Ask Jill at jillonmoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Welcome back. During the break, were you sitting down and coming up with the actual amount of money you can afford to contribute to your kids' college education? All right, maybe not. But we are talking about college financing, and we've got a great guest. We've got Kelly Peeler in the house, and in the middle of this next segment, her boss, David Klein, joins us. They're from CommonBond, and this is a really interesting organization where they are providing financing, and they're also helping people navigate the financial aid maze, and it is a maze, all right. In this segment, we are going to discuss how different financial aid packages are sent out to families and how confusing it can be. You can look at 3 different offers. It could seem like the same stuff, but different terms. So here's more of our interview with the folks from CommonBond. So one of the reasons that I wanted to bring you in is that when I saw you recently, because I was on the CommonBond campus. I like calling it a campus. It makes it sound bigger. All right, office. I was in the CommonBond office hawking my book is what I was really doing. Kelly was nice enough to sort of say, hey, come talk about your book at our company. And as I was there, you put in front of me 3 different letters from 3 different institutions to the same person, right?
Yes.
Okay. And so
Same student.
Same student. And what you were showing me was how different award letters can look. And I found this fascinating because, all right, so let's go through this.
And let's just say what an award letter is.
Okay,
so
go.
Even that is a little bit misleading. So when you get into college, yay, celebration, I got in. Then you get your financial aid package. So that's basically your bill. However, colleges deem this as your financial aid award letter, which sounds like you're getting a prize. But it's basically your bill. It's a breakdown of the cost of tuition and then also like what you might get with scholarships, grants, and different loans, which are somehow bucketed in there and sometimes subtracted from the total cost. But it is what we're looking at is one student's options or bills to go to 3 different colleges, and they're called financial aid award letters.
All right, so I'm just going to let's just pick this one. We won't say what university it is. All right, so now we're looking at, let's call it Wasamatta U. And here at the top, tuition and fees, $38,868. Room and board, $15,000, total $54,000. And then, of course, by the way, they say indirect costs not reflected on bill, books and supplies, transportation, miscellaneous.
Miscellaneous of $600.
And by the way, this is such a low number, it's ridiculous.
Yep.
It is. There's no way that's the number.
Right.
Okay, so now let's go down, and now we have the total estimated cost of attendance, both direct and indirect. They say it's $56,000, and it says your financial aid package is based on this figure.
Yep.
Here is the financial aid award package. And there are 2 semesters. There's fall, there's spring.
Which, let me just point out, this is only for 1 year. So most students go to college for 4, call it 5 years on average. They might do an extra year, right? So you're only getting a bill for 1 year. And the reason why I say that's important is because the cost of higher education has consistently gone up. Tuition prices have consistently gone up every year for the past 30 years. So it's really hard to plan ahead and make a decision if you're only seeing the cost for 1 year.
Okay. So there's a lot of stuff in here, right? We have the Dean Scholarship,
Yep.
which I guess is a scholarship, mean that you get it, that's your money, and it's not taxable, and that's that?
Yes.
A
so
plain old
that
scholarship.
is plain old scholarship. You don't owe it back.
And then you get another thing that's an award, which is also
Don't have to pay it back.
don't have to pay it back.
Yep.
Then there's a space, and it doesn't say anything else here, just a space. Subsidized Stafford loan, $1,750. Unsubsidized Stafford loan, $1,000. Federal work study, $1,000, and then federal parent plus loan. And then you look down, and if you don't read this carefully and we don't decipher all of this, we see $28,291 is what you think you're getting.
Yep.
So-
Because that's like the total line.
That's the total line for this semester. And then the same for the second semester. And there's the total, which miraculously is $56,000. Okay, so
Cheap, right?
cheap. But what's interesting is when you look at that, when you look at this first glance, what's happening is 11, 12, 13, 14. So there's basically 15, about half of what they say is your award per semester
Yep.
is, in fact, a loan.
Yep.
And the other half is, in fact, a scholarship.
Yep.
You know who just walked in?
David.
David Klein. Hold on a second. Hold on. Pick up that microphone. Where the hell have you been?
Courtesy of the New York City MTA system, I am 15 minutes late.
This is unbelievable. But just calm down. Take a breath. Take some water. We'll do a proper intro in a second.
All right.
Okay. All right. So now, half of this scholarship, half of this is loan. So a couple things that pop out for me. That's not clear. It is
Absolutely not.
It's true that it is. It says loan, work study, and then loan,
But there's no interest rates there.
and there's no
either.
term,
Right.
And there's nothing that says, hey, if this is going to be paid back in 10 years, this is what your monthly amount
Yep.
will be when you graduate,
Right.
right? All that we have at the loan eligibility, and they have like little loan stuff here with nothing. I accept and I reject.
Right. So you literally click a button that's like accept without knowing interest rate, without knowing monthly payment afterwards, without really knowing the terms.
I find this mind-blowing. Why?
This is what I'm trying to tell you,
I
Jill.
know. So one of the things you pointed out to me when we first met a few years ago, maybe longer than that, but it's been a while.
Years, yeah.
We've known each other, was that there was no standard format
Yes.
for reporting this. Why not?
Just because it's not mandated by the Department of Education. So every college has their own little financial, or not little, sometimes massive financial aid office, and they determine how they want to communicate with students about their own financial aid process. So all the letters aren't even sent out on the same day. So what happens a lot of times is that parents, if you have divorced parents, one parent might get one letter, another parent might get another letter. You put them under their bed, you lose the letters, you don't know where all these things are. They're in different formats. So kind of long story short, this is a very confusing and opaque process.
So what should this kid do right now?
Yeah, great question. So what we've actually introduced to help a student solve this problem is the first major problem, which is let's actually compare your options apples to apples. So right now you're looking at like apples, oranges, tomatoes. You're looking at different ways of evaluating each different opportunity that you might have. And so what we do is a student can text us these award letters, and we will put them in an apples to apples comparison so that they actually see, okay, for across all of my colleges, how much am I taking out in total loans? How much am I getting in total scholarships? What will be my work study across all of them? So we lay it out really clearly so that they can say, literally, what do I have to pay and what do I have to owe?
Let's bring in David Klein now. David,
Hello.
the tardy David,
Yes.
welcome to the broadcast center here in CBS. You must live in some far away place. You just look so MTA'd.
It's this
You
far
just
out.
got MTA'd.
It's this far out borough called Brooklyn.
This is why I don't go to that borough. That's exactly why I don't go there. So now Kelly has identified this great program that is essentially helping kids with these decisions today. And David, you are the CEO of CommonBond, which acquired Kelly's company. First of all, what is your background? Why did you get into this? Let's talk about, what's the mission of CommonBond? Why the hell did you get into this business?
Sure. So the mission of CommonBond is to lower the cost of higher education in the U.S. And the reason I got into the business is very personal. I went back to business school. I had to pay my way 100% with student loans. And my options at the time really stunk. The rates were unnecessarily high. To Kelly's point, the process was complex. As well as to Kelly's point, the service was really poor. My ability to just understand my options to pay for school were very limited. And I pretty much had to create that system for myself. And I realized other people were just like that. And I thought, there's got to be a better way. And I went back to business school with the express purpose of starting a company and running it before graduating. I come from a family of entrepreneurs. I always knew that's what I wanted to do. And so there was this perfect storm of the personal pain point needing to borrow to go to school, and it was a stinky process.
Okay, we will get back to more talk about college financing in just a minute. It is Jill on Money. During the break, why don't you go to the website, jillonmoney.com, and you can sign up for our free weekly newsletter. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money. A lot of people taking their high school students on some college tours this summer. We got a little college on the mind because I know that there are also parents packing their kids up, getting them ready to go to college for the first time or the second or third time. We are talking about financing of college, and we've got some folks from CommonBond, a really interesting company, portion of which is private student loan financing and also education in the form of money-mentor.com, where trained college students help out high school and college students to help navigate applying for college financial aid. So all of that is there. This is the end of our interview with Kelly Peeler and David Klein of CommonBond. All right, so David, you have a lot of different loans and opportunities to refinance.
Mm-hmm.
So let's talk about the refinancing first. Mm-hmm. So it seems to me that we're doing a pretty bad job explaining to people how to pay down loans. How does CommonBond approach the refinancing process?
Sure. What we do is we say, hey, most of you have a federal government loan. That federal government loan comes with effectively one interest rate, no matter your credit, no matter your future prospects. And so it's a highly inefficient pricing scheme. And so what we do is we take a look at every individual borrower. We collect all of their data. We underwrite past credit, future prospects, and then we provide a lower rate for those who are eligible. And so when we provide that lower rate, we're saving people many times hundreds of dollars every month, thousands, tens of thousands over time.
So when you do that, just so we're clear, you then do not have the ability to use some of the government's products like the public school loan forgiveness program. You forego that. And you also forego the income-based repayment, right?
Right. So there are, and we're very clear about this with our borrowers and our applicants from the very start. We say, if you have a federal government loan, it comes with certain protections that only the federal government can offer, like income-based repayment, where you pay no more than 10 to 15% of your income on any given month.
And you will die with that loan, ladies and gentlemen.
We're very clear that because for some people, income-based repayment or public service loan forgiveness is still better. And so we're very clear about that. It just so happens there are a lot of people who don't need that and instead can save a lot of money in return. And so we help those people out.
So, Kelly, talk about this in terms of the Money Mentor program as well. Like, how do you wrap in the idea up front about how the debt that you are assuming could limit your options in the future? How do your Money Mentors talk about that?
It is within our best interest and CommonBond's best interest to ultimately make people more creditworthy. right? So if we can help a student negotiate their tuition, they'll theoretically have lower loans, which means that they might be able to refinance later on or be a better credit later on because they're doing something like taking a job or improving their credit score as opposed to worrying about their undergraduate student loans.
David, when you look at this $1.5 trillion, what could be done realistically, not with Betsy DeVos as Secretary of Education, okay, but in a perfect world, what would happen with the federal student loan program to make it operate more feasibly, like in a healthy way?
That is probably a more complex question than you might fully appreciate. When I hear that question, I think it has to do with, one, just the structural elements of student loan program in the United States right now. The fact that the federal government represents over 90% of all student debt. A lot of the pipes underneath the surface, a lot of the technology underneath the surface, and the servicing underneath the program is all farmed out to a bunch of vendors who don't exactly have the best history of putting a customer's interest first. To be fair to them as well, they're working within a context, an operating sphere that is highly constrained. And so that's where you get a lot of these headline issues of customers not being treated right. It's because fundamentally, structurally speaking, the system is in fact broken. And so the question then becomes, okay, well, what do you do about it? I think there are a few different constituents that really matter here. One remains the federal government. One is the private sector. Private sector in two forms. One, private sector to offer better products and services. And two, private sector employers of many people in this country who have student debt. There's something for both to do. And then the borrower themselves.
Kelly, the fastest growing segment of student loan borrowers are over the age of 60. So I know they don't have the total, the raw dollars aren't as big, but they are the fastest growing. Talk a little bit about these plus loans. How should families be approaching this?
Yeah, so Parent Plus loans are for parents on behalf of their student, and you have to have a good credit score. So
or at least a decent
a decent credit score. And obviously that kind of changes over time. But yeah, it's more if you think about loans in terms of expensive or being expensive, it's more expensive than the subsidized and unsubsidized loans.
David, do you actually allow for the refinancing of parent loans as well?
We do. Yeah.
And do you find that that's a big need? I mean, you've got a lot. I guess you have a lot of competition for that because parents have more access to the credit markets.
They do, technically speaking. Not many people, though, understand that they can refinance their Parent Plus loans, whose interest rates are insanely high.
So when we look at what's happening now, are you feeling good about this?
If I think about it from the consumer's perspective, both at a macro level and a micro level, I'll start micro first, very personal. We know that more people are taking on more student debt. What we also know increasingly, especially given a Fed study that was released in Q1 of this year, is that that is starting to impact individuals' ability or willingness to do things like take out a mortgage and buy a house or buy a car. And so to the extent this student debt train isn't kind of taken control of in some capacity, this will likely continue to put stress on people on a micro level, as well as continue to put stress on the economy at a macro level.
This all has to end. And it's not going to end well, is it, Kelly? Optimistic or pessimistic right now?
I mean, I studied financial
like
crises,
the voice
so
of doom right here. That's why we got along.
I'm on a macro level pessimistic. On a micro level, to David's point, on the user level, I'm optimistic. And the reason why I say optimistic is because Gen Z, our user, so the next wave of millennials, are starting to treat college like they are consumers of a college education experience. And that's very different than how millennials treated their college experience, which was to say, great, I got into Princeton, have to go. Now you see people taking gap years. You see people negotiating their tuition more. They're treating it like it's an actual service, which it technically is.
Thanks so much to Kelly and David. The website, it's CommonBond.com. And if you'd like those trained college students to help out your student who's applying for financial aid, money-mentor.com. Money-mentor.com. It's Jill on Money, and we will be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that takes the mystery out of your financial life. Yeah. If you got a financial question, anything, maybe you've seen something I've done or heard something that we've said here on the program, you want to follow up, just send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. You can always go to the website, JillOnMoney.com, click on the Contact Us button, and we will follow up. That is what Jean did, who said that she saw a segment I did on television about renting in retirement. And Jean says, I chose to sell my house and rent, and I'm paying $2,025 per month. But I've had to deal with an apartment that wasn't sanitized. Yeesh. Listen to this. I've had to deal with mold, rust, tar in the dryer, and other tenants' filth. I've been cleaning ever since I moved in. Yuck. Nothing was painted. Carpet wasn't shampooed. I could not inspect the apartment before I moved in. So here's something. Honestly, there's your key. If you cannot inspect the apartment before you move in, then you cannot take the apartment. And she follows up and says the lease specifies you have to occupy the day it is made available. Okay, but you have to see the apartment. Anyway, poor Jean hired a lawyer. Little has been done. She contacted the Board of Health, state representative, other state organizations. They only deal with discrimination or uninhabitable conditions. I'm going to file a complaint with the district court. What about small claims court? I mean, I don't know. Isn't small claims like less than $500? Anyway, I've seen other apartments, spoke to other tenants. They all had their apartments cleaned, painted, or had the carpet. What else can I do? Hey, you know what I would do, Mark? What do you think about calling the newspaper or the local TV station and maybe consider, ratting out the landlord? See if you can just sort of shame the person or threaten to do so at least. Okay. Oh, gosh. Poor Jean. Just what you need, right? If someone puts a gun to your head, even if it's a great deal, you got to see these places before you move in. Take this lesson from Jean. All right, Jed writes, I currently own a life insurance policy, on my parent. It's worth $100,000, 20-year term. Yeesh, $888 a year in premium. And the policy was taken out while a trust was being put in place for the farm to protect for inheritance. Okay. It's now looked at as more of an investment opportunity. I'm considering converting to a whole life or universal life option, about $4,000 a year universal life. Premium, $7,500 a year whole life. Oy, oy, oy. Our budget gets pretty tight. Any of this with the higher premiums would actually stop me from maxing out my $457. I say no. Look, I don't know. How much is the farm worth? And I don't think this is an investment property or anything. I mean, look, it's okay to have a policy if you think there's going to be a liquidity issue, meaning I can't sell my farm. But I would get a second and third opinion, for goodness sake. Oh, my gosh. I just go to napfa.org. Go find somebody to give you a second opinion. Okay. Here's another one about the subject of renting versus buying after I did a segment on CBS this morning. So here's the thing. At the end of the segment, you talked about renting versus buying. They can use them to rent for a while. I don't think I said rent for a while. I think you could rent. If you are going to buy a house again, I don't think that renting is a real problem. I really believe that for many people, they plunge into a different home ownership opportunity. They might say, hey, I'm selling my house in, say, Chicago and moving down to Florida, and you think that's a great idea, and you go do it, and then you hate Florida, and you got to move back. So I think renting, if you really think you want to move to another place, renting for a year makes sense. But here the question is from Weston. When does it make sense to sell and then rent? Is it only if you need the money, or is there a sound financial reason? There's a sound financial reason just to give you the flexibility to see what is out there and what you really want, because sinking the money immediately, again, into real estate may not make sense. And if you don't have a lot of liquid assets, if you don't have a lot of money saved, you may be far better off renting and having that liquidity. Question from Susan: is Trulia a reliable source for real estate values? I live in Michigan. I'm 71. I've got a realtor. I'm having trouble selling my home to find a new one, hopefully out in the country. I check Zillow and Trulia, but what does the housing market look like in a few months? The country homes here are expensive, but sometimes a cheap one comes along with work. But mine, no one seems to want. You know, there's a rule in real estate that if your house has been on the market for more than, say, 3 or 4 weeks and you haven't had a bite, you may want to reduce the price. So I will just say that for a lot of people, you don't like that idea, but, you know, I would also wonder if, you know, you wouldn't want to buy something before you sell your current home, especially if you're having trouble. Listen to your realtor in terms of just getting guidance. The market is changing pretty rapidly. I can't speak to the exact situation in your neighborhood and your area, but what I can say is that a lot of these sites are good for basic fact finding, but it's on the ground research which you and your realtor are going to have to do that's going to get you where you want to go. I think that's the key issue. All right. Some real estate questions, renting, etc. You got questions? Let us know. Just send us an email. Ask Jill at jillonmoney.com. And hey, go over to our website, jillonmoney.com, and you can buy my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. It's right there at jillonmoney.com. Just click on the link at the top. It's called The Book. Okay, we'll be right back. You're back. It's Jill on Money. We are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. All right, here's a message from Josh, who enjoys the show and says that he and his wife currently have, you ready for this? $90,000 in credit card debt. I don't even know what to say. That just hurts me. They have $130,000 in a 401k. It looks like the penalty would be $12,000. So big penalties to get their money out of their retirement account. $1,000 a month in interest on those cards is just killing us. We need to correct our overspending, which has been going on for several years now. Okay, we have a $1,600 a month mortgage and utility bills of $1,700, currently a month in advance in payments. You know, you didn't tell me about the house. I'm wondering, I don't want you to use the 401ks because it sounds like you're actually, unless you are over the age of 59 and a half, I don't think you mentioned that. If you are over 59 and a half, then you could potentially pull money out, but then you still have to pay tax on it. Would you be able to borrow against your 401k? That's not great either. Not a great one. What about, could you refinance your home? Is that something you could do? I need more information. Josh, can you follow up with me? Because I really think that there's maybe another way, another solution. I just don't want you to feel like you're trapped with the decision of pulling money out of my 401k or not. Maybe, again, borrowing could be a possibility. Maybe refinancing the house. Give us a little more information. Maybe we can help guide you some more. Okay? Liz writes, here's the subject line. This is when I wish Liz would just record this. Maybe we should have people just record voice messages into their phones and email them to us. Liz writes, loved your book. I just wanted to send you a quick note letting you know that I loved your book. It was perfect. I especially appreciated the information on getting our will updated and life insurance needs properly reviewed. It also made me realize that I need to plan for my aging parents. We just don't have any plan in place. Thank you for some incredible advice over the years. Keep podcasting, broadcasting, all casting. Hey, thanks so much, Liz. If you want to buy the book, just go to jillonmoney.com. You can get it yourself right there. Click on the link. It says The Book. All right. We will see you next week. If you've got a financial question, just send us an email. Ask Jill at jillonmoney.com. Thanks for listening, and we will talk to you next week.